Think about what it was like right before the 1930 Great Depression started. Now, how did things go from being so incredibly prosperous to so devastatingly bad so quickly? Unfortunately, for most people, they don't want to consider that when times are good, that things could change instantly and that economic pain could be right around the corner. But it's historical reality that some of the most economically painful times are preceded immediately by times of fake abundance. And so if you want to know what it looked like right before the Great Depression, look around, because the reality is that everything that's happening around us right now, economically speaking, both from a theory perspective and from a historical pattern perspective, are flashing warning signs of economic danger ahead. And stick around, because I'm going to give you the theory, then how it plays out in reality, and give you what you can do to foresee in real time what to do to hedge against this. First, let's look at the boom and bust cycle theory. Now, this is commonly called the business cycle or the debt cycle. And this is a product of fractional reserve banking and central planning. It is not a product of free market activity. And so here's exactly how this plays out. Imagine with me, we've got a small isolated economy. One person's the banker, one person builds houses, one person makes clothes, one person has crops and farm animals, and so on and so forth. Small isolated town. Imagine a little house on the prairie economy. Everybody has their gold in the bank, and the bank issues paper receipts that can be redeemed for that gold at any time. But the bank wants to make some extra profit on the side, so they open up a new service called lending. Now, prior to the bank offering its own lending services, if you or I wanted to borrow money in this economy, it would have to be money that somebody else is not spending. So if Michael wants to borrow money from Jim, that means Jim cannot go and spend that money that he just lent to Michael under a sound money standard. That means that debt does not increase or decrease the money supply. The money supply is constant. And saving, spending, and borrowing happen as a result of individual choices based on economic activity and subjective value. But as soon as the bank offers lending services, they are creating new paper that doesn't have any money to back it up. This means that when the bank loans out money, they are lending money into existence, money that was not there before. That means as a result, because they don't have to give up any of their own purchasing power to make a loan, they have the ability to make loans underneath the natural interest rate. They can undercut all other lenders. So the bank starts loaning money like crazy, and people have an appetite for borrowing because the interest rate is so attractive. Somebody borrows money to build an addition on their house. That means construction workers have way more income than they used to. And then they go out and buy new clothes. They spend more money on entertainment. They have extra income, and then everything that they buy is now income for somebody else. And you have the money start to work its way throughout the economy. Remember, money that was lent into existence that starts to bid up prices, and people feel this artificial fake boom. They think that times are great, incomes are going up, but what they don't realize is that boom was built on debt. At some point in the future, one of those loans has to get repaid. And when that repaying of the loans begins, that marks the top of the boom and the beginning of the bust. Remember this. And now the banker has two options. Option number one is to just lower interest rates yet again, and this will restart that cycle. And instead of allowing the boom to turn over into a bust, it'll just send that boom up higher, because instead of actually paying off the debt, people can just borrow new debt to pay off the old debt and continue the cycle forward. More money floods its way into the economy. As money gets cheaper and cheaper, debt becomes easier and easier, and incomes go higher and higher. But eventually something breaks and prices start to inflate. Now, if the banker keeps this up and continues to lower rates and flood the economy with more and more money that is being loaned into existence, eventually the money just loses all value. People dump the currency, a bank run happens, and they try to get whatever gold they still can, and everything collapses. And during that time, a lot of malinvestment took place. People made economic decisions that they would not have made without the new flood of cheap money entering into the economy, without that easy debt, which means that certain prices were pushed artificially higher. The hyperinflation that takes place at the end of this path means that eventually everything crashes back down. All that malinvestment is exposed out into the world. And like Warren Buffett said, only when the tide goes out do you discover who's been swimming naked. But the banker does have another path that they could choose. Once they start to see prices run out of control, they can force the debt to get repaid intentionally. And this is by, instead of lowering interest rates to continue effectively printing more money into the economy, the banker can decide to raise rates. This means all new borrowing effectively stops, which means that as debt service payments continue to get made, there's an automatic deleveraging that has to continue to happen. Otherwise, the economic pain that grows if people continue to take on new debt is larger and larger because the cost of servicing that debt is greater and greater. So the banker will continue to increase interest rates until the deleveraging occurs, but what the banker doesn't realize is that this has the same net outcome as the hyperinflationary route, which is all that malinvestment and all the misallocation of resources gets exposed. Remember, this is something that happened during the boom, think the roaring 20s. The bust is when it's revealed, think the 1930s. The damage is done during the boom when people make economic decisions based on false information. Decisions that they would not have made without that artificial changing of the interest rates and the money supply. So that's the theory, but how does that play out in reality? Now here's a chart of the federal funds effective rate. Now since the Federal Reserve is a central bank, this is just like our story of the bank with the isolated economy. In order to stimulate economic activity, the Federal Reserve starts to lower interest rates in 2001. Now that caused malinvestment and a misallocation of resources, which fueled the housing bubble before the Great Financial Crisis. But instead of letting that bust unravel, they decided to lower interest rates again, this time to zero. Too scared to try and let the economy handle it, they kept interest rates at zero for many years before they started to raise again in 2016. But towards the end of 2019, when it looked again like the bust was about to come out of its hiding, the Federal Reserve lowered interest rates again to zero in 2020. And as you know, all of these were accompanied by increasing amounts of money printing. And in 2021, inflation finally started coming alive, and this time the Federal Reserve decided to try and make the bust happen. And since then, they've been raising interest rates at a faster pace than they ever have in history in an attempt to force the economy to deleverage. Now, the deleveraging hasn't started yet with the opposing force of the federal government loading up on new debt, which is now at nearly $34 trillion, and with household debt continuing to rise. However, as a result of interest rates continuing to go up and the money printing stopping, the money supply is actually shrinking, and is shrinking at a faster pace than it has since the Great Depression. Which means that if the theory holds true, we should see signs of malinvestment and misallocation of resources starting to pop up across the board. Signs of malinvestment are 1, prices getting ready to collapse, 2, an overabundance of supply, and 3, investments made into things that will not be brought to completion because people read incorrectly the economic activity that was taking place. They looked at information that was false because it was skewed by the money supply and the fake growth. So where are these signs popping up? According to the uscourts.gov, bankruptcy filings were up 16.8% from the year 2023 from 2022. Now we've all heard of the commercial real estate vacancies across the US. Now this is a prime example of investors getting used to a low interest rate environment and then making bets accordingly. Now typically commercial real estate loans mature in 5 to 10 years. So these investors that invested in the past 5 to 10 years are forced to refinance at rates that are 2 to 3 times the rate that they were banking on initially. Now this obviously is something that's going to leak out into the banking sector, and currently small banks hold over 70% of commercial real estate loans valued at over $2 trillion worth of loans. Meanwhile, $1.5 trillion worth of loans are said to be refinanced at a much higher rate, that 2 to 3 times the rate that we talked about, by the year 2025. And this is all at the same time that office vacancies are at historic highs and the commercial real estate market is in a bear market territory. Now this same malinvestment happened in the banking sector with Silicon Valley Bank and with many other banks investing in long-term treasuries that are now underwater due to them purchasing the bonds in excess of 0% yield, in which these same bonds now yield around 5%, resulting in a complete collapse of the bond price and a huge blow to their balance sheet. Now, one of the major signs of economic hardship is just that the things that people want and need are difficult to obtain. So looking at something as superficial as just the price on a chart going up doesn't answer the question, why is it expensive, and is it expensive relative to income? This is important when looking at something like housing, considering that at the moment, over 80% of borrowers currently have a mortgage locked in below 5%, and over 60% of borrowers have mortgage locked in below 4%. And the most staggering is that nearly 1 in 4 people have a mortgage right now below 3%. So if any of these homeowners sell their homes to move, they would be trading that mortgage out for a new mortgage around 7%. This means few people can afford to sell right now, so both rents and the price to buy are staying extremely high, making the cost of living very painful for most Americans. And one form of debt that is seeing delinquencies take off rapidly is credit cards. Credit card delinquencies are now over 3%, which may not seem like a lot, but it's higher than the peak in 2020 before the money printing started, and you have to go all the way back to Q3 of 2012 to find a higher delinquency rate. And considering that the interest rate on credit cards have only recently surged to multi-decade highs, this trend is only just beginning. The boom causes malinvestment and a misallocation of resources that is exposed during the bust, and the damage is already there. And finally, if we look at the stock market, this is the valuation history of the S&P 500, also known as the CAPE ratio. This ratio is used to determine whether the stock market is over or undervalued. You'll see that the historical average is right around 20% for the past 70 years and 17% for the past 140 years. We've been above the 70-year average since 2012, and that's 14 years of constant valuation without once reverting to its original mean. Our current valuation is at the same valuation that the S&P 500 was at right before the Great Depression. But in the last 20 years, we've seen unprecedented amounts of money printing and lowering of interest rates. Now, what does this do? This causes the boom to continue, pushing the valuation of the stock market to 140-year highs. The pain is just getting started. This is what it looks like prior to the bust. This is the inflection point to the change from the boom to the bust. These are the signs of the malinvestment and the misallocation of resources that are just now beginning to be exposed. Asset valuations are just now starting to realize the destruction that is built in. Now we'll see if the Fed and the government decide to allow the natural reallocation of resources that needs to take place throughout the economy, or they decide to kick the can down the road some more by printing more money, bidding up prices, and artificially keeping rates lower than the market rate.